All right, let's get right into it. You know, a single financial decision you make today could literally be the difference between having a few extra lakhs or tens of lakhs in your bank account a decade from now. It's a huge deal. And today, we're diving into one of the biggest financial showdowns in India, the classic steady fixed deposit versus the more dynamic mutual fund.
So let me ask you something, and I want you to be honest. That money you've tucked away in a safe place, you see the interest trickling in, and it feels good. But are you actually getting wealthier? Is your real-world spending power going up? The answer, well, it might just shock you.
Okay, let's pull back the curtain on the villain of this story, inflation. You see, a fixed deposit or an FD might give you, 6–7% returns before tax, right? But here's the catch. Inflation is also chugging along at around 6–7%. It's like this silent tax that just eats up all your gains. So that means your real growth, the growth that actually matters, it's basically flatlining. It's close to zero.
So if the math doesn't really work out in our favor, why are we so incredibly attached to FDs? I mean, what's going on there? Well, it turns out it's not just about the numbers. It's about something much deeper. It's about psychology. It's about tradition. It's our comfort zone.
And you know what? It totally makes sense. For generations, this was the way. Our parents or grandparents, they all swore by FDs. And back in their day, they were getting incredible returns. We're talking 10, maybe even 12%. So we've kind of inherited this belief in this guaranteed safety. And let's be honest, there's a real comfort in seeing that number in your bank account just steadily ticking up, never going down. It's simple, it feels safe, it's like a warm, cozy financial blanket.
But here's the problem. And it's a big one. The rules of the game have completely changed. That comfort, that cozy blanket, it's really just an illusion now. That feeling of safety is coming at an enormous cost, because with today's low returns, your money is actively losing its buying power every single year.
All right, enough with the abstract concepts. Let's make this crystal clear. Let's talk about a tale of two friends. We'll call them Rohan and Samir. They both started with the same amount of money at the same time, but they made two very different choices.
So here's what went down. Back in 2013, both Rohan and Samir invested 5 lakh rupees. Rohan played it safe. He put his money in a fixed deposit. Samir, on the other hand, decided to go with an equity mutual fund. Now let's fast forward 10 years. Rohan's 5 lakhs grew to about 8.95 lakhs. Hey, not bad, right? It grew. But Samir's investment, it ballooned to a whopping 15.5 lakhs. Just think about that. Same money, same 10 years, but a completely different world of results.
That difference, 6.55 lakhs. That's the whole story right there. And look, that's not just some number on a slide. That's a family trip abroad. It's a down payment on a new car. It's a massive head start on your kid's college fund. That's the real-world power of choosing growth.
You know, there's a financial term for what Rohan experienced. It's called opportunity cost. It's simply the potential gain you give up when you pick one option over another. For Rohan, the price he paid for that safe feeling, for that psychological comfort we talked about, was over 6.5 lakh rupees.
Okay, I can almost hear what you're thinking right now. This all sounds great, but what about the risk? Mutual funds are risky. And you're right to think that. It's the #1 reason people stay away. So let's tackle this fear head-on. Let's really talk about what risk means when it comes to your money.
Seriously, this is the big one, right? But mutual funds are risky. What if the market crashes? It's a totally valid question. We see the news, we see the market jump up and down, and yeah, it can feel pretty scary. That volatility is right there in your face.
But here's the thing. There's a secret weapon against market volatility, and it's called time. Look, if you're only investing for 1 year, yeah, it's a roller coaster. Anything can happen. But stretch that out to 5 years, historically, the chances of actually losing money go way, way down. And if you stay invested for 10 years or more, well, time has this incredible way of smoothing out all those scary bumps. The long-term trend of the market takes over. Time is, without a doubt, your single best friend in investing.
So this is the key takeaway. There are actually two different kinds of risk at play here. With mutual funds, you have a visible risk. You see the market go up and down, and that can be scary in the short term. But with fixed deposits, you have a hidden risk, a silent risk. It's the risk of your money's buying power just fading away because of inflation. It doesn't scream at you from the headlines, but believe me, in the long run, it is so much more dangerous for your financial goals.
And that really brings us to the heart of the matter.
At the end of the day, this isn't just about financial products or returns percentages. This is about what you want your money to actually do for you. This is about the future you're trying to build.
Just take a second and think about it. Why are you even saving this money? Is it for your child's education, which we all know gets more expensive every single year? Is it for that dream home you've always wanted? Or maybe it's for a comfortable retirement where you don't have to worry about a thing. Financial freedom, a better life for your family. All these big, important dreams, they all have one thing in common.
They don't just need your money to be safe. They desperately need your money to grow. They need it to run faster than inflation, to build real wealth so that you actually have the financial firepower to make those dreams a reality. You see, stability is nice, but it's growth that builds the future.
So, I'll leave you with this one final thought. Take a hard look at where your long-term money is sitting right now. Is it just staying safe while its actual power is slowly draining away? Or is it out there, working hard for you, fighting off inflation, and actively building the future that you and your family truly deserve? The choice, as always, is yours.